Hello, good morning, traders. It's Tuesday. It's a very interesting week we have today because we will have, especially tomorrow, is a very interesting day. We'll have the Fed meeting. The FOMC meeting is already started, but on tomorrow we'll have the decision about the interest rates in United States. So I hope that you are well prepared for this because you know this is an event which will usually give us a lot of emotions, let's say this way. The Fed decisions have huge impact on all instruments. On one moment, because sorry guys, I have some echo in this. Uh, One moment, something's going wrong. I see here in the headphones. Moment. Mm, well, something is going wrong here. I don't know why. Okay, so I have something here to close. Okay, so sorry guys, there are some technical problems. Today I will speak about a strategy which is based on price action and MACD. This is something which this is a strategy which combines two methods because we know that when there's a price action, um, we don't watch usually indicators, and this strategy is something which is combining the only price action, so watching the charts, and MACD, which is an indicator, which is a kind of a filter, is helping us to find uh, the answer for the question, is this setup worth trading or not? This is, I call it a three-step strategy because it's we first we search for a pattern, a candlestick pattern, then we wait for the market to break out from that pattern, and at the end we try to filter it. We try to uh, check if this setup makes sense. MACD is an indicator, well-known indicator because it was built many years ago. It was the constructors. It was constructed by Mr. Apple in 1979. So you might wonder if an indicator which was invented 44 years ago makes still sense. Does it work? Yes, it works, and the strategy I'm using is one of the proofs that it works. What can I say about the strategy itself? It's very it has a high win ratio. Of course, what is important is to follow the rules, to keep up to the assumptions of the strategy, which, by the way, are very simple. The only thing which sometimes might be a problem is when you have to decide if a pattern is worth mm, trading or not. It means that you need to verify the patterns, and the way to verify a pattern is this is the idea of this session. I will try to explain you. I see some friends on the chat. I had some problems to log in, but now I see the chat is on. And I see Mr. Black, I see Mr. Danushka, I see Mr. Balrai. Nice to see you guys. If you have questions, please ask. I'm ready here to answer. The question is always why the patterns, the candlestick patterns we use, we try to analyze why they work. Because with so many times you can hear that the history makes it's no sense to watch the history because the history mustn't repeat itself. Every day is different. Different people are trading at today, different tomorrow. Yeah, that's maybe true, but not to the end, because we must remember that the market is driven by people who are trading on the market are driven by emotions. And those emotions are with us for hundreds and hundreds of years. That's why it often happens that in similar situation, people react in a similar way. And one of the four of those emotions I listed here, and probably you know those emotions, you have already met those emotions when you were trading. Of course, greedy is first thing that we are greedy. We want to have more. That's why we are trading. We are trading to have more. We fear that something might not work. We ignore signals given by the market. We are so focused on our mm, setup that we don't see anything else. We are just so focused, but market is signaling that there are some changes coming, but we don't see it because we just believe that this will go like we expected. And of course, we hope that everything will go well. And that's why the formations we see on the charts are still repeating themselves. And that's why we can plan a strategy which is based on those patterns, which could, when they are repeating themselves, they very often also the market moves like it happened before. There are dozens and dozens of patterns, but believe me, it's no sense to learn all the patterns. You can find in the internet a lot of tables with patterns. Here's some samples, but it's no sense. It's no sense because um, if you would try to learn all those patterns and you would like to remember the names and where it works, you would lose a lot of time. It's really nonsense. Look at those patterns here. 8 bars, 10 bars, 12, 13 bars. And what's the meaning of those things? Why you must believe that the market will go this way or this way? If it's 12 candles, they show they will go up. If it's 13, they'll go down. No, forget about this. All those patterns, it's no sense learning those. I have chosen only a few patterns known, and those patterns are here. In my opinion, this is enough if we understand what they mean, because it's not the best way to learn those patterns in the way that okay, this is a bullish harami and this will go up, and I have to note it. More important is to understand why it works, not just because it's Marubozu, then it will go down or up. We need to understand the meaning of those patterns. And I believe that the best patterns for this strategy, which I'm using, are the patterns which we call inside and outside bars. Inside and outside bars, those are very specific patterns because they are built of two candles, and it's enough if they are built of two candles, and you can already expect what can happen. Uh, Usually, those patterns are change or continuation of a trend. The pattern itself is a consolidation. It means that price cannot break out from the range of the former candle or cannot break out from the second candle, which is creating the outside bar. Inside outside bars are very simple pattern. That's why it's worth trading those, because you can see that such a pattern straight away. You mustn't wait, like here, you mustn't wait 13 candles to make a decision. You have two candles and you can say, okay, price is in the range of the former candle, which we call mother candle, and we are waiting now for a breakout. It means that if a candle is this candle is the maximum of this candle is broken, it means that price decided or market decided to go higher. If the bottom is broken, market decided, okay, it's enough growing now, let's start falling. And of course, not always will it work this way because sometimes the pattern could be a continuation pattern. It means that they will just break the top and go further and another one, another one. So I use a filter to um, avoid entering in a wrong direction. And this filter is called MACD. This is an indicator, which I mentioned at the beginning of my speech. How those inside bars work? Well, usually you can take a look at a chart, typical chart. This is an inside bar pattern, okay? So we have an upswing. On the top of the upswing, we have a pattern, very typical pattern. Oh, Mr. Ioannis is also here. Hello, nice to see you. By the way, guys, remember that the chat is for you. So if you write a question on the chat, I'm happy to answer. If only, of course, I'm able to answer this question. So the inside bar is built of three types of candles. Mother candle is the candle which is creating the pattern. This is the size of the pattern in that moment. So from the top to the bottom, maximum and minimum, they create the area. Then comes the inside bar. Inside bar, it's very important that its maximum is lower than this maximum, and minimum is higher than the minimum of the former candle. Then we can say this is an inside bar. And then comes the third type of candle. This is the breaking candle. And very important candle because this candle usually initiates our trading. It's our, let's say, signal candle. Very important because what this candle means, it means that the market after a consolidation in this area decided to break out. It means that the sellers took over the market. The sellers rules here, rulers. And it very often happens that such a pattern, which is on the top of a swing, is the beginning of a downswing. Because market usually is moving in swings. Market is usually moving in downswings like this, and upswings, bullish swings like this. And what you see here, we have see another inside bar pattern. Look that those three candles are inside bars because they cannot break out from the range of the former candle. It's also inside bar pattern, but it is a bit longer, let's say. And then comes the moment when a candle opens in the range of the pattern and closes outside. This we call a breaking candle. So this breaking candle is here also. And what means that the market broke out from the pattern? It means that after a period of indecision, the markets took a decision, made a decision, let's go down. And this is our entry level usually. Of course, we can wait and see if there will be a test of this pattern. Test means returning to the bottom of the pattern. And then maybe this could be a better entry, but sometimes it can happen that they will go really strong and they might not test like this. They might go straight away. So the decision is up to you, or either you open now or open after the retest. But generally, when you see something like this, you have a big chance that you will properly identify the direction. So breaking up from a pattern is like breaking up from a consolidation. It usually gives us a hint in which direction the market might plans to go. And the second type of patterns is outside bars, okay? Because those are inside bars, and outside bars are even more interesting. In my opinion, those are the most productive patterns. They usually give us really very good hints where the market plans to go. And And watching such a pattern means waiting for a setup. This setup here, we can also mark this way. It means that the size of the outside bar pattern is the size of the engulfing candle, yes?